This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusoya. Welcome to the show. Today's episode is a bit of a fanboy moment for me. I am joined by the powerhouse that is Fran Kinniry. Officially, Fran is the head of Vanguard Investment Research Center. But if you've been around financial planning for more than 5 minutes, you would know Fran as the architect behind the Vanguard Advisor Alpha, which in my mind does for financial advice what Newton did for gravity, which is to help us put numbers, words, and credibility around this thing we intuitively know, but maybe have found difficult to express. If you cut Fran open, please don't. But if you did, you will probably find Vanguard running in his vein. Fran Kinniry, welcome to the show.
Thank you, Abraham. That was such a nice introduction. I hope I can live up to that. I appreciate it.
It's a pleasure. I really do mean that because I've been familiar with your work for over a decade now. You've been at Vanguard for nearly 3 decades. So give us a whistle-stop tour of your career. How did you join Vanguard, and how did we get to where we are today?
Yeah, so I started out as an advisor. I was in the wealth management space. We were a fee-based advisor, and that wasn't all that common. In the early days, we were already doing fee-based and really looking out for our clients' best interests. At the time, a lot of our competitors were trying to do asset management in a fee-based way. And as we know, asset management is hard, meaning it's hard to outperform the markets. And the case for indexing is pretty strong. Asset managers and hedge funds do this 24/7. And to be a wealth provider, working with families and doing tax planning and wealth planning, and then also thinking we could do investment management well, we quickly learned that that was a tough challenge. And so I was at that firm for 6 years, already had been to business school, already had my CFA, and Vanguard was starting advice, our direct advice business. Yeah. And that's how I got to Vanguard, to really start our direct advice business.
So you started the direct advice business, and then you went on to start a few other groups at Vanguard. Tell us a little bit about that.
Yeah, so when I got to Vanguard, it was starting the advice business, and how I created Advisors Alpha. You know, you mentioned Advisors Alpha. Sometimes your greatest adversities lead to creation.
Right.
And so I'm there in the early days, and Jack Bogle and Jack Brennan are still, Jack Brennan is the CEO and Jack Bogle is still there. And they said to me as we were starting advice, we had no clients yet. It was just really a business plan to start advice. They said, so let me get this straight. You're going to charge 85 basis points for a package of funds that doesn't do tactical, doesn't do active. How does that have any value? And it kind of, led me to explain to them that most of the value was in the wealth management, eliminating all of the tax drag, making sure that we get the right funds, because it's hard for investors to pick among the millions of funds that are out there and then rebalance, stay the course through behavioral coaching. And so we were able to show them first that yes, clients do need help, and they will pay for it, and the paying for it will pay for itself. And that led to Advisors Alpha.
And talk a little bit about the Advisory Research Center today. What does that do?
So my team, what we cover is really all of the spectrum of investment selection, wealth management, private assets versus public assets, portfolio construction, but we do so towards the advisor. The advisor is our end client, and so we're speaking their language, and a lot of that is what to do, but also what not to do, because a lot of times it's what not to do can add more value than what to do. And so we call ourselves the advisor to the advisor. We're trying to help the advisors because our whole mission is to help end clients And if we can educate and coach the advisors to really do best in class investment, wealth planning, financial planning, we think that'll accrete back to the end client that is being advised. And if those clients do well, the advisory practice will do well. And so really it's that momentum of the end advised client doing well. That means the practice does well. And then the flywheel starts to turn.
Yeah, it's incredible. So you joined Vanguard 27 years ago, and I heard this from you, one of your talks, that Vanguard at the time was around 300 billion of assets. So the first 25 years of Vanguard, they'd gone to 0 and 300 billion. The next 25 years, this Colossus is gone to 10 trillion. I mean, what does it feel like having the front row seat in this incredible journey that Vanguard's been on?
Yeah, it's been amazing. As you mentioned, when I got there, the first 25 years, we went from, a startup with, case for indexing was un-American, if you will.
Yeah.
And advisors didn't want to use index funds because their proposition was outperform, right? So why would you use index funds if your goal was to try to outperform? So when I joined, indexing assets on advisors' portfolios were under 5%. Now they're north of 50%. And so I would say when I got there, we had a bold aspiration to make wealth management better, more professionalized. And we actually, to be able to see that play out, to see index assets go from 5 to almost 60%, to see Vanguard go from 300 billion to $10 trillion, and to see advisors really embrace what I would call the professional parts of wealth management, financial planning, wealth planning, behavioral coaching, and avoid, the fad or, chasing returns and buying 5-star funds, if you will. And so it's really revolutionized the wealth management industry right in front of our eyes, watching that play out, which is great to see because at the end, who benefits is the clients that are advised by the advisor. And then I think it also, it really increases the whole brand of advice because now advisors are actually doing something that they can tangibly say adds value to their advised clients.
So we'll come back to some of this conversation around, perhaps, advisor value, that sort of thing. But you blew my mind at a presentation when I was in Philly with some of our leadership team, and this comes to on the subject of market concentration. Yeah. So there's been a lot of talk recently about the dominance of the Mag 7 and why that is some sort of existential threat to financial to indexing, or so should advisors be worried about market concentration, and why?
Yeah, I think it gets a lot of attention in the media, as you mentioned, and you start to see 7 companies making up 25, 30% of the U.S. markets. But I think what gets missed in all of that is just how strong these companies are. And when we look at the revenues of these companies and the operating earnings of these companies, one could argue, why aren't they worth 40 or 50% of the market?
That's what you said.
I mean, some of these companies are greater than many countries' total revenue and earnings. And so all I would caution advisors and investors is that the way the market cap gets figured out, so why would Apple or Microsoft or NVIDIA have a market cap as it does, is it's an auction market, right? So securities trade in an auction market with many, many informed buyers and sellers. And so, there's high frequency traders, there's hedge funds, there's private investors of all sorts. And if they felt that the value of NVIDIA or Microsoft was overvalued per se, they would want to sell that stock and they would have to find other buyers. And if there's a crowd of sellers versus not as many buyers, what makes the market clear is the price would drop. And so the market cap is the consensus forward-looking forecast based on all information, right? And so we have to think about that. Like just the strength of these revenues and earnings and what the growth potential is, these companies are being priced for the next 3, 5, 10 years, not looking backwards. Not to put anything about Vanguard's context there, but we talked about Vanguard growing from 0 to 300 billion in our first 25 years, then the next 25 years from 300 billion to 10 trillion. These companies are set up with these long J curves, meaning that they make all of these investments and then they have this network effect. And then they start to grow pretty rapidly, and then the earnings explode. So I think active managers see that, and they see that the value that they are bringing to the market. And so I would say be careful about betting against those companies. The case for indexing has been pretty strong through history. And so betting against or underweighting these securities, I would say, carries as much risk. And we see people trying to underweight them because of the valuations, and they've really suffered the consequences of that.
One of the piece of work you referred to in your presentation was Besson Binder's research. The way you laid this out says to me, on the one hand, there is risk, there is risk if you bet against these companies because they've got the incredible moats. The consensus views of the investors is that they are going places.
Right.
But then I'm thinking, an investor might say, well, if I am in a position where these companies represent, 8-10% of my portfolio individually, right? Then if anything happens to any one of them, maybe NVIDIA no longer, retains its position in the marketplace as the dominant force, in the chip market, then I'm going to lose 8% or 5% of my money. How should they process this type of risk?
Yeah, I think you referred to the Besson Binder research, and we've done research that supports that or rhymes with that or confirms that. And just for the audience who may not be familiar with it, what it says is that the stock market returns, let's just say 8 to 10% compounded annually over a very long time period, the vast majority of that return comes from a small percentage of the stocks. It's actually like 4 or 5% of the stocks are responsible for 100% of the return. So it is very much like the venture capital market. What I mean by that is made up of unicorns. It's not made up of the median stock getting 8 or 9%. The median stock is like 25% of the average. And it's these unicorn stocks, these 4 or 5% that are really responsible for the majority of the returns. What I would say on specifically to your question on NVIDIA is like, what if you would have sold that 2 or 3 years ago? Even thinking that it is already at astronomical levels. The stock could drop really now at 95%. We've done the math. And you still would have been better off owning the security because of so much of the returns on the front side. So will some of these 7 stocks have big declines? Absolutely. They may even drop 50, 60%. But the question is underweighting them on this journey. You never knew when to get on or off the train. Right? And so owning them on the way up, even if they were to drop 2 times what the market would drop, you would have still been better off having these securities in your portfolio because we're forgetting about the thousands on thousands of percent returns that these stocks have already given you. And so the idea of like, you're not going to know when to get out of these stocks. And so the best idea is don't go against the case for indexing. If you are going to underweight them, I guess our only advice would be do it very smallly, do it in a small percentage. Do not, fully underweight these securities.
With a factor tilt, maybe. I know you're not a fan. You're a big fan of factor tilt. Would you think of that as a way to maybe slightly underweight this company?
If that was the preference of the advisor, what I would say is the case for indexing and the Besson Binder research, everything we have shown has shown don't bet against the market cap. It is the case for indexing. If indeed it was easiest, sell the largest companies or the companies have had the best returns, the Besson Binder research would have said the opposite.
Right, yes.
The case for indexing would not work. And so all I would say is throughout market history, betting against the market cap index and betting against these unicorn stocks has not worked. It may work in the future, and so if you want to underweight them with a factor, the future is always uncertain. I always say that, but you are betting against history, and if you're going to do that, my only advice would be do it in a small measure. So let's say you've 75, 80% market cap, and then if you wanted to underweight it, do so at the fringe. Because also, back to the advisor, your end clients are going to start asking you, those who have bet against these stocks, I would imagine are having tough conversations with their clients. The last 3-year, 5-year, 10-year, they might have even gotten fired. And so my advice to advisors is try to get as close to the market portfolio as possible. Do all the things you do well, like know your clients, wealth planning, financial planning, make sure they're in the right asset allocation, and try not to make yourself be an asset manager, because the case for active is pretty hard. And I would imagine most advisors have many other jobs they're trying to do other than outperform the market.
I agree with you entirely on don't bet against these companies. What about market concentration at country level? So in other words, the US today is now, 65% of global market cap weighting. And the problem with you Americans is that you think you're exceptional. Are you exceptional? So in other words, how are you thinking about market concentration at country level as opposed to individual stock level?
Yeah, it's interesting. Everything we just talked about, the Mag 7 and those 7 stocks being concentrated in the US. If you look at all the other countries, the top 5 stocks are more concentrated within the home country even than the Mag 7. Yeah. So, it is interesting, again, back to the Besson Binder research and all others, is that, there are these unicorns that dominate all the markets. You go country by country, and the top 5 or 10 stocks make up a large portion of each country's index. We believe in being globally diversified. And, depending on what country you're in, that may look different, right? So we work with clients and advisors throughout the world. And so the home bias is real. So because you're trying to save money to retire or save money to gift to the next generation. So there should be some home bias. So what that means is a UK investor might have a different UK allocation than an Australian investor, than a Mexico investor, than a Canada investor, and then a US investor. But at the end, you should think about all of that. What is the global market cap? And as you said, the US has been, over the last 20 years, somewhere between 50 and 65% of the world, and then the world would be the rest. I would say, again, try not to be too far from that. But certainly if you're in your own country, you would then, in the UK or Germany or whatever, you would think about how much of a home bias do I want? And then once I have that home bias, look like the global cap of the rest of the world.
But you wouldn't be underweighting the US just tactically, for instance, in the light of, Trump, a tariff, some people are talking about possible repricing of American equities and, forecasting even the decline of the dollar, relative to other currency. Would you think of that as a reason for underweighting US equities?
We've done so much work on tactical asset allocation, and the fund industry as well has funds that are tactically allocated. And all of the research shows that those tactical funds at the median and the average have given up 1 to 3%. So
they lost 1
to 3%. So I think to do tactical asset allocation, we could have said the same thing about the US 3 years ago and 5 years ago. They've been outperforming for the last 15 to 20 years. And you would have really gotten yourself hurt had you have done that. But there is a way you could almost take advantage of that. And what I mean by that is you would have your country weights. Let's say you were a UK investor and you felt that your home bias in the UK, you wanted to say, I'm going to make up a number, 30 to 40%. And the rest of the world would be 60 to 70. And once you had that, you would be rebalancing to that level, which means that since the U.S. has been so dominant over the last 10, 20 years, you would have been rebalancing instead of tactically adjusting to your ratio. And so by that definition, you would be ensuring that all of your assets didn't get concentrated in one country. But tactical asset allocation, again, I would be the case for indexing and the case for tactical has pretty strongly said how hard that is to do.
Okay, so let's move on. Let's talk about, private equity. So I know that Vanguard recently made inroads into private equity, and you helped launch the private equity fund. Why? What is it? What is an investor looking for that they can't get through public markets?
Yeah, so a lot of people may have thought, wow, Vanguard going into private equity. We thought Vanguard was low cost and all public markets, but really what Vanguard has been an innovation company, much more than any. If you were to say, give us one word that describes Vanguard, I would say an innovation company. And what I mean by that is that when we first started, we started out with active management. People think that we're all indexing, but we're the largest active manager in the world. Of that $10 trillion, close to $2 trillion is active. So we do believe in active management. It's what we really do is we bring world-class talent at reasonable costs. And then our active funds have actually outperformed the active peer group, and they've outperformed the index that they track. And so what we've had a history of is bringing world-class institutional portfolios down market, maybe democratizing or retailizing. And so private equity has been around for a long time, used by pension plans, endowments and foundations, family offices, but the average investor didn't really have access to that. So Vanguard, we decided, and I was part of that launch, helped us launch that, how could we bring private equity down market, like out of just that 1% of the family office market? And we were able to do that. And the reason is because the public markets are just a small part of the equity market. Most equity, if you were to look at equity in general, is private. It's not public. And there's been this whole idea of staying private longer. And so a lot of what used to get made up of value accreting in small caps or mid caps, these companies are staying, most of that value creation is now happening in the private markets. And then they'll only do an IPO when they're already a large cap. And so we thought they would, diversification, giving our investors part of the equity universe that is private, gave them a good diversification and access to more of the equity market. That was our inspiration to do that. We launched that in 2000. We've announced another partnership with Wellington and Blackstone. Nothing more to report on that, but we're going to continue to try to bring private investments to the average investor, just like we did with public markets.
One of the advantages of public markets is all of those things that you said earlier on, the rigor, the pricing, the price discovery that goes on from multiple parties in getting to the truth, call it, about the price of that security. You also have liquidity in the sense that whenever you decide that you no longer want to hold a particular stock or security, you can sell. How does that work in private markets where, all these companies are public? How do you get to the truth about the value of those companies? And how are you thinking about liquidity, especially in a fund structure for a retail investor?
Yeah, we're thinking that most investors do not need to have 100% liquidity.
Right.
Let's just say investors may have a 10, 20, 30, 40-year time horizon. And right now they have 100% of their assets public and liquid. They could sell everything tomorrow. And the question would be, if there is an illiquidity premium, which there should be, we see even in the treasury market on the run, off the run, the ability to have something locked away that you're not able to sell has carried a premium to it. And so I would argue, why wouldn't an investor with a 20 to 40-year horizon be okay with 10 or 20 or 30% of their portfolio that they still have 70 to 80% of the portfolio that's highly liquid, that prices every day. Everything you said was true, Abraham. No price discovery, hard to understand even what the value is. It's an appraisal market. There's not a listed auction. You can't sell it. All of those things are very true. And so I think what we will also bring is education on all those things. And then investors should not own anything in the private markets unless they are willing to have it locked up for 10, 20, 25 years. But we would just argue, isn't 70 or 80% liquid good enough if your horizon is that long, and that we believe there's a premium there, both in the illiquidity premium, plus in the alpha that private market investors can create on behalf of our investors.
So let's talk about the alpha then. Is there really alpha? I've seen a lot of research around this that basically says, the median private equity fund underperform, the S&P 500, essentially. So where is the alpha in this, in private equity?
Yeah, you're exactly right. I mean, you do not want to get the average private equity fund, right? And I would say the same thing in public active. You do not, everything we know about active management on public long only is that the median and average fails. The question I always ask is there something about the top quartile? Is there some similarities, or are there some things that top quartile has that give you a high probability of them remaining in the top quartile, whether they be public or private? And we actually find that there is. And what we see is really talented teams, right? Like if you have talent relative to your competitors and you price it well, there's something very similar I mentioned our active funds on the public side outperform both their benchmark active and passive. It's because we have high talented managers and we give them a low cost, and those two ingredients put them in the top quartile more often than not. So the answer on the private market is very much the same. If we believe Vanguard can do the due diligence, so I'd be very cautious for the average investor or even advisor to do private investments on their own. They should probably be working with someone like Vanguard, who's doing all the due diligence on the manager, making sure that we give you a higher chance of being in the top quartile and negotiating fees on your behalf, because you do not want the median or average private equity manager or even public active manager. You want to try to be in that 65th to 95th percentile. And if you can get in that range, just above average, then there will be some alpha there.
So how does it work? The going rate in the private equity market is what? 2 plus 20 is what they talk about.
Yes.
What can I expect when I come to Vanguard for this thing? What can I expect in terms of pricing? What does it look like?
Yeah, the pricing, it's a private market. So what that means is the pricing is not public. It's a qualified offer. And so terms and conditions of that offer are only really discovered once we know you qualify. It's not a publicly listed rack rate that we talk about. All I can say is the terms and conditions are favorable, meaning
significantly lower than 2 plus 20?
Yeah, so I would say it would be similar that if you were looking to do private equity, but instead of being a $1 million family or a $5 million family, you're getting terms and conditions that a pension plan might get.
Right.
So we've negotiated fair fees for private equity fees. So they're not going to be anything like index funds, nothing like public markets. But even after those fees, the managers that we have worked with, we see that the returns have still been 2 to 3% above public markets. Right. And so, again, you do not want the average and median return, as you pointed out, Abraham. The average and median return is going to give you illiquidity, no price transparency, and underperforming the public markets. So you really want to go in saying that I believe that Vanguard or someone like Vanguard is giving me access and selection into that top quartile of managers, and that of all the managers we work with, because it's a manager of manager program, meaning multiple managers, that we're able to put together a portfolio that gets us in that 65 to 90th percentile. And if we're able to do that, which our partners have, we've seen returns of 300 to 400 basis points above public markets.
And are you, in terms of the access to this, are you qualifying? I know this is, mostly to do with the US. We don't have it here in the UK as yet. But are you qualifying at investor level or at advisor level? If a financial advisor comes to you on behalf of their client, are you qualifying the underlying investor?
Yeah, so we just went into this market in 2000, and our first offer was a qualified offer at the individual household level. So that means the actual investor has to qualify. But that was our entry. And we said at the time in the press release, and we just had a new press release on our relationship with Wellington and Blackstone, that's not where we're finishing. We're going to continue to try to do what we did to the public markets and the private markets, and that is really helping investors take advantage of these private markets by working with Vanguard. And so, as you mentioned, we don't have anything yet in the UK. We don't have anything other than the qualified offer, but we are working very hard to try to bring it to our partners outside of the US and also down market for advisors.
So a cynical view might say this is Vanguard's play to defend against the onslaught of BlackRock. How do you respond to that?
We really don't think of our competition all that much. Our goal and our mission from day one was to take a stand for all investors and give them the best chance of success. So we're really just out for the end investor. We're not really concerned or thinking about the competition in that way. Our competition is really about how can we continue to bring world-class investments to end investors and advisors, because that's really what our goal and our mission. Our goal and mission is not to be better than any one of our competitors. It's really how can we help the most of our clients. That's what gets us up every day.
So let's, as we start to go towards the end of this, let's talk about your what I consider your most important work, which is the Advisor Alpha Framework. Talk to us about how you come to this number of 3% or more. What is the benchmark for that? How do you arrive at that number?
Yeah, so what we did is we were able to actually look at how all investors invest. And what I mean by that is the cash flow and how portfolios are managed. We have transparency to that. We know what the ratio of stocks to bonds are. We know when cash flow is coming into stocks or out of stocks. And so we say that the counterfactual or the portfolio that is all investors is publicly known. We have all those through cash flow and others. And so we say, what is the return of that portfolio of all investors? And then we compare that to a portfolio of doing the right thing, if you will, or doing best-in-class wealth planning, financial planning, behavioral coaching. And from that, we're able to compare the delta between the two. So for example, if the average investment cost of an equity mutual fund out there is, I'm going to just use up a number because it changes every day, 40 basis points. But alternatively, you could have built an all Vanguard portfolio at 10. That's 30 basis points of leakage, right? So you would say, here's a best-in-class portfolio at 10 versus what all investors own at 40. That's 30 basis points of leakage.
Wow.
What about the internal rate of return, which measures cash flow coming into the market and going out of the market? And usually it's investors coming in at the top, underweighted at the bottom. We have a counterfactual now. We know what the dollar-weighted return is of all investors because we know what the equity and bond and money market flow looks like, and we can measure that versus a portfolio that actually just stayed the course, that rebalanced through time. And there we see another leakage of about 1 to 2%. Then we talk about like tax-efficient retirement income. How much, if you can get a check or a money market account where the client can spend out of every month in the most tax efficient way versus how actually people do it. And so we're able to kind of create this counterfactual portfolio of what all investors are doing versus the optimal portfolio. And then there's the delta between those two. And again, what we always say is it's between 0 up to 300 basis points and maybe even more. because it's at the individual level, right? Collectively, we would say it's probably closer to that 2 to 3%. All investors, but some investors may be doing it already really well. And for those investors, it might be closer to zero. Others may be doing it really poorly, and they may be losing 600 or 700 basis points. But when taken together, we think that world-class wealth management, tax planning, behavioral coaching, investment selection for the average investor, when we look at all investors, can add 2 to 3%. And that to us is really good, because if the advisor charges, let's say, 1%, then their business, less what they're creating, still accretes economics to their client. So I call it a win-win situation where the clients are winning, better than if they were on their own or advisor not doing that. The advisor is getting compensated for all the work that they're doing. Advisors do a lot of work. And so everyone can win in that value cycle.
So you're on record for calling this a bull market for financial advice. Why is it now? Why is now such a golden era for financial planning?
I would say a couple things. One, demographics. And what I mean by that, the amount of individuals that are going to be over 50, 55, 60, 65 is growing as a percentage of the population. And decumulation, meaning how do I live off of my portfolio, is much more challenging than accumulation, right? When you're in accumulation, you put your money in, but when you're trying to take money away from the portfolio, live off of that portfolio, you want to make sure the portfolio doesn't run out. You may have a bequest motive, taking it out in a tax efficient way. All of those things can add tremendous value. And investors are going to need to rely on their portfolio for some of their living expenses. So demographics is clearly one. Two, technology and innovation have really given the advisor more ability to take advantage of these financial planning software, tax planning software, so they can do a lot more for their clients and spend more time on human-to-human interaction. Because that's what I think most clients want in their advisor. They want to have a relationship with their advisor where they know them more intimately. They know about what their goals and objectives are. All of that takes time over a cup of coffee or a face-to-face meeting. And so those are the ability of technology and innovation to let the advisor spend more time on the human aspects. And as demographics age and decumulation, I think all of those lend itself. Complexity is another one. All of that will lend itself to investors needing more help and the help adding value. So you put those two together and we think it's a bull market for advice.
It's incredible that all of these things that you've just said, very little of it has to do with actual investing and portfolio management. Right. That is clearly not a place for advisors to add tremendous amount of value.
Yeah, I would say if you go back to the case for indexing, right? Like the case for indexing is pretty strong on the equity side and the fixed income side. It's unlikely, and I mean this with the most respect, it's unlikely that the average advisor is going to beat a Vanguard diversified portfolio. We track it very closely. We see a Vanguard 60, 40, 70, 30 outperforming even the best hedge funds, pension plans, endowments, and foundations that have deep investment teams that do it 24/7. So to think that the average advisor is going to do that, it's just the probability of that is low. And so what we're seeing is this shift from the advisor being an investment manager to being a wealth manager. And I call it the professionalization of this industry. Trying to think of yourself as a portfolio manager, investment manager has a very low probability of outdoing the index. And then think about would you be able to outperform a balanced portfolio index by 1%, your fee? I mean, the odds there are probably 1 in 10 or 1 in 20. And so that's a really old value proposition that probably needs to be retired. But the wealth planning, financial planning, tax planning, behavioral coaching are all enduring. And so it's great to see the industry migrate over the last 20 years towards being a wealth manager instead of an investment manager. And I can't see many investment manager-centric advisors being around in 5 to 10 years.
Yeah, so fascinating. It's been really good talking to you. I want to close this with a few rapid fire, questions to you. The first one, what book do you most recommend to advisors?
Probably the book I would most recommend probably be Stocks for the Long Run.
It's a classic.
Yeah.
Yeah, good. What's in your retirement portfolio?
I keep my portfolio simple, as the conversation probably had. I'm heavily indexed. I'm also a high net worth investor, so I use tax efficient bonds, so municipal bond funds. But I believe in the equity risk premium. I'm a long-term investor, so I would probably be closer to 60-40, 70-30 stock bonds, and a very simple, plain portfolio, probably not more than 6 funds.
Incredible. What's one ETF you never part with?
The Vanguard total stock market portfolio.
And what's the biggest misconception about Vanguard?
I think the biggest misconception of Vanguard is that we are just an index and an equity index fund. As I mentioned, we're one of the largest active managers out there. We're also one of the largest fixed income managers out there. A lot of people may think of us just on the index equity side, but we actually have a large active, $2 trillion on the active side. We're one of the largest fixed income investors out there. And our performance on fixed income is among the best out there. And so we're much more than equity and much more than index equity.
What keeps you excited about this work? 30 years in, 27 years in?
Yeah, I think 27 years in, what keeps me most excited is I still think we're very early in this professionalization of advice. And what I mean, going from this value proposition of, I call it hoping I can find investments to outperform, to a much more professionalized, high probability of outperformance. And so I'm very optimistic and look forward to seeing where the advice business goes in 3, 5, 10 years, because it's really going in a positive direction.
So, Saint Jack Bogle, what do you think you say about Vanguard at 50?
What would Jack Bogle say about Vanguard at 50?
Yeah.
I think he would be extremely proud. I was very, very lucky. I consider myself one of the luckiest people at Vanguard. I got to know Jack really well, and we had lunch 5-10 times a year up until his passing. I think he would be very proud of what has transpired. How many investors, 50 million investors, taking advantage of what was his vision 50 years ago.
Fran Kinniry, it's been great talking to you. Thank you for your time. Thank you for the incredible work that you do in our space. And thank you for coming on the show.
Thank you, Abraham. It was great to be on the show, and thank you for having me on.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.